occasion. We've been holding it twice a year for the last few years, and it appears like you all continue to enjoy coming and listening to what Justin has to say. May I welcome Justin McLaughlin, our Head of Research, our economist, and please feel free to ask as many questions as you would like. There are no wrong questions and there are no bad questions. Thanks all.
Thanks very much, Suki. And I'd sort of very much echo those sentiments. You know, it's not a big gathering, so please just interrupt, ask questions, disagree. That's always good. And we'll have hopefully a conversation rather than a lecture, which would be great. Okay, market update, disclaimer. So I'm going to start just by talking a little bit about the Australian share market. And as always, there are opportunities and problems in any share market, and just to try and sort of tease out some of the issues and some of the things that we think are relevant in today's environment. So let's start out by talking about banks, because banks are a very big part of the market, and Westpac yesterday came out with a bit of a profit downgrade and a capital raising and cut dividends. So banks are topical today. And the first chart I'd like to show you here is just are banks outperforming or underperforming the market? And the blue line is just the ratio between banks and the market. So it's going up, banks are doing well. If it's going down, banks are not doing so well. And the shaded grey areas just sort of illustrate those periods in which it's doing well and not so well. And the really big question, I think, is, you know, what are banks likely to do running forward relative to the broader market? And so it might help to stop and take a look and say, well, what really drives bank profitability and what really drives the opportunities in the banking sector? And there are many things that it gets quite complex, but we can always try and distill it down to a few of the key issues. And when we try and distill banking down to the key issues, one of the things we need to understand is at the end of the day, banks are shops that sell credit or shops that sell loans. And, you know, if you look at this, it just shows credit growth in Australia for both investors, this is property investors, and owner-occupiers, property investors, owner-occupiers. And as you can see, I think loan demand in Australia has really fallen away quite sharply. The investors are almost out of the market, not out of the market, they're not growing their share of the credit pie very much. And the only owner-occupiers are still there. And so if you're a bank, and one of the key drivers for you is lending, lending is still positive, but it's happening at fairly low levels at the moment. The interesting thing when we looked at the Westpac result, this is just from the release that Westpac did the other day, is for Westpac in the fourth quarter of the year, or the last quarter of the year, this just shows new loans written and sort of runoff. And most of the time, Westpac writes more new loans than it has running off or maturing. But interestingly, for this quarter, for the last quarter, there was a small negative. In other words, for that quarter, probably Westpac shrunk its balance sheet a little bit. And I think this is consistent with an Australian consumer that's very, very heavily indebted, and an Australian banking system that's moving from growth to stability and sideways movement over the next little while. And if you think about it, it's probably relatively straightforward, and that is, if you spend the best part of 2 decades building up debts, it's not unusual to expect that maybe for the next 3 to 5 years, you look to get those debts under control. So from a bank's perspective, it means their sales growth is likely to be quite low for the next 5 or so years. And we did note that Westpac cut their dividend, and expectations are probably that some of the other banks will cut their dividends as well. Probably NAB would be next, potentially. And you know, there are a number of reasons for that, but one thing we do need to understand is Australia is a bit different from other markets insofar as in Australia, companies tend to distribute a very large part of their profits as dividends, whereas in other markets they don't. So the ratio is sort of 70 or 80% for the Australian market, about 40% for other developed markets. And there are different reasons for that, but one key reason is basically dividend imputation was introduced back then, and since then this gap has widened. Well, that makes sense, obviously, because if you can distribute franking credits back to people, then they're going to value those distributions quite highly, and so that's why, in many ways, banks and companies in Australia generally do have big distributions. Banks are probably distributing more than 80% at the moment, and the only problem with that is if you're distributing 80% of your profits, then you do have to be, if you come into any sort of problems, then you do have to potentially cut those dividends. And a lot of people obviously own banks because of the high dividend yield. And the tale I tell is not one of woe to banks, but it's just of caution and to suggest to you that chasing dividend yields too much to the exclusion of other considerations can be a mistake, because dividends can always be cut, potentially. The other thing that's happening to banks globally is we're moving into very much a low interest rate environment. Now, in Australia, we've had three interest rate cuts in the last 6 to 12 months. It's quite a lot. Don't think the RBA is going to cut much more. We'll probably cut once more, but that's probably it. So how do banks do in a very low interest rate environment? And remember, banks really make money on the spread between what they borrow and what they lend. And at some point in a very, very low interest rate environment, that spread starts to get quite compressed and their profitability starts to get quite compressed. So in Europe and in America and Japan, particularly the latter two countries, Japan and Europe, we've really seen the banking industry perform quite poorly in a very, very low interest rate environment. So there you can sort of see Australian banks and American, Japanese and European banks. Very, very low interest rate environments tend to be pretty average for banks. Now, they haven't gone backwards, but they haven't gone up at all for the last X number of years. And it's very hard for a bank to make money if interest rates are very low for a long period of time. And final thoughts on banks are, we sometimes look at the Australian share market and think, oh, of course it's 35% banks or whatever it happens to be. But that hasn't always been the case. Right now financials are a big part of the benchmark. At different times resources have been, at other times other sectors have been big. And these sort of things have swings and roundabouts. I guess what we would say is, look, we've probably been in the best couple of decades we've seen for banks. And we're probably now in a consolidation phase and a phase of paying back debts rather than leveraging up for the next few years. And again, I'd say that doesn't mean we don't invest in banks, but it does mean that we don't crowd too much into banks to try and clip those high dividends, particularly if they may potentially suffer additional dividend cuts down the track. So what about the Australian share market more generally? So if we look at valuations, and we can measure valuations just using a price to earnings ratio, which is just how many times this year's earnings do we pay for the market. And the Australian share market is pretty fully priced historically, right at the upper end of the range. It isn't crazily priced, it isn't at exorbitant levels, but it's very fully priced. And that kind of flows on from the fact that interest rates are pretty low and people have been crowding into all other assets to try and get yield. The issue, of course, is we've now driven the market to fairly high levels. But when we look at the Australian share market, we need to understand that the market is really built up from a number of different sectors, each of which has quite different valuations, and we have some very expensive sectors and some not so expensive sectors. So let's just try and analyse that in a little bit of detail. So this just shows you the Australian share market, the industry weights, so 35% bank, 18% materials, the US share market, the same weights, and the price earnings ratio, or the valuation metric that we use to sort of assess value. You can sort of see Australian banks, so Australian materials looking relatively cheap relative to materials in the US. Now that may mean there are some different styles of companies mining different things, but looking fairly cheap. The interesting thing I think is if you look at technology, in the US it's 22% of the index, it's trading at a multiple of almost 20 times. In Australia we have a little tiny tech sector, but boy is it expensive, trading at 34 times. Healthcare is sort of also another one, which is quite interesting in the sense that in America it's 14% of the market, and here it's about 10. But in America you can buy healthcare companies for about 14 times, and here it's about 31 times. Now, some of the healthcare companies in Australia are amongst the best stocks we have in the index, but they're certainly fairly expensive at the moment. There are some big, cheaper sectors in the Australian market, which tends to sort of pull the index down. Resources tend to be fairly cheap, and banks are always relatively cheap. But the interesting thing there, I think, is you do have some very expensive sectors, particularly technology and healthcare, where, you know, even relative to US valuations, they're looking pretty stretched. Now, not to say they're not good stocks, but they're looking very stretched in valuation terms. So if we look at the technology sector, we've got the famous wax stocks. You know, in America they have the FANGs, which is Facebook, Amazon, Apple and Google, and China they have the BATs, which is Baidu, Alibaba, Tencent. In Australia we have the wax stocks. This is sort of, you know, WiseTech, although that's had a bit of a shakeout recently, Afterpay and the others there. The interesting thing, we can try and illustrate just how expensive these are, is I've just gone and looked at the market capitalisation of these stock companies, and they add up to about $32.2 billion. So there's a lot of value in these stocks, right? $30+ billion of value. And I've just gone onto Bloomberg and looked at the most recent estimated profit numbers, and it's about 141 million. So if you divide that by that, you get 228 times. So these companies are trading at really rich premiums. Now, maybe it's a little unfair to include some of the negative earnings in there, but it doesn't really matter. I mean, they're trading very, very richly. So much so that these look pretty much like the old tech bubble in America. And for those of you who've got long memories, you can go back to the 2000s. And at that point, we had companies like Oracle and Microsoft and Cisco and all the others, which were the market darlings of the day. This is just a measure of valuations. You can see how extreme the valuations got. And you can see today how, using the same valuation metric, our little wax stocks are performing. They're very, very expensive. Now, of course, you can see there in the adjacent chart just what happened to technology in America after that peak. We've exceeded that peak. Doesn't mean we fall away from here, but I think there is an element of caution in chasing those interesting and maybe very, very good, but very, very expensive stocks too much higher. So that gives us the interesting challenge of, well, where do you invest in the Australian share market? And one of the big quandaries in investing at the moment is, are we going to invest chasing growth style stocks, which is you know, a technology style company? Do we pay a large price for a very secure earnings stream in a high quality company like like a healthcare company? Or are we willing to accept perhaps a lower quality company, perhaps one with some cyclicality, and seek value, seek more, much lower valuations? And in terms of the positioning of our portfolios, for the most part, we are somewhat tilted to seeking value, and it's been exactly the wrong thing to do for the last 2 years. Growth investing has just killed it. It's done really, really well. But you know, I'm not sure that's going to be sustained indefinitely. So if we look at value investing internationally, we can sort of see just two measures of value and growth. Value is sort of, as the name implies, cheap stocks and a number of objective measures. Growth is the other. Over time, value investing tends to do pretty well. And the reason for that is, generally speaking, if you buy something cheap, it works out quite well for you. But the situation's been reversed over the last few years internationally, and growth has really outperformed value. And I guess the question is, what happens next? So what we can do is we can sort of look at this and look at all the different industry groups and look at how they're valued and try and look at, well, does it make sense today? So I think if we look at healthcare, we can all agree healthcare is a good sector. You know, demographics favour it. We've got some great companies like ResMed and CSL and a few others in there. You know, a good growth-oriented sector should be trading at a fair valuation multiple. In other words, the green line should be at the top of the band. Banks tend to always trade relatively cheaply to the rest of the market, and the reason for that is banks are levered about 25 times, and if you have 25 times gearing in your portfolio, well, that's what banks do have, you know, you need fairly low share prices because, you know, there's a bit of inherent risk in all banks over time. So they tend to trade at much lower multiples. So there's nothing abnormal about a spread of valuations between very high quality companies and not necessarily bad companies, but just companies with different business models that should naturally trade at lower values. The real question though is, I guess, how wide should that spread be? And you can see historically how wide it's been. Clearly there has been a spread. We have favoured some industries and sectors above others. The interesting thing I think you can see here is just how wide that spread has become. And therein lies the difference between why growth-oriented investors have really outperformed value-oriented investors. Value-oriented investors sort of clustering or finding more opportunities in these sectors, and the growth guys are chasing these sectors. And that's kind of the story of the market, or the Australian market. It's a very bifurcated market with people really paying up for growth and certainty of earnings, and really penalising anything that has any cyclicality. And that's having implications for how different fund managers are performing and how different portfolios are doing as well. So if we look at different portfolios, I've just got the Vanguard Australian Index Fund. That's the performance, I think, 2 years to August this year. Done very well. Here are a bunch of value managers, Investors Mutual, Schroders, Perennial Value, Perpetual, all have that valuation discipline. They've really underperformed over this period. And what's been happening is the market's been driven as much by this part of the market, and the value managers have been clustering there. So I think the interesting thing now is what happens running forward, and our argument would be that this wide dispersion will narrow to its more normal range. It may well be the case that healthcare stocks are still the most expensive and the most highly valued of stocks. That probably should be the case. But the dispersion between those and the other sectors should be much lower. And how could that happen? Well, these could go up, or these could go down, or there's some sort of combination of the two. My suspicion is these move up a little bit and these move down quite a lot. And so really, when you're investing in the Australian share market, should you be more biased towards value-oriented investments, perhaps using more value-oriented fund managers to pick your stocks than the broader indices or growth managers, and that would be our argument. So what about international shares? What do we look there? What do we look at when we look at international shares today? And again, I guess it's as with the Australian share market, there are some good opportunities and there are some expensive sectors. We've shown this chart on a number of occasions, I think. It just shows various international markets, you know, Europe, Asia, Australia, US. The orange bars are long-term average valuations, or long-term average PEs. The blue bars are current valuations. And the good news is most share markets are actually trading fairly close to their long-term averages, which is, you know, implies they're at roughly fair value. The US share market stands out as a really expensive-looking market. And again, if you were to correct all markets down, a whole bunch of markets would probably, if you were mean revert everything back to the average, a number of markets would actually go up in the US market. If you mean reverted it instantly, it would fall by about 46%. We're not saying that happens, but you can sort of see just what a standout it is on these measures. And this is just the century's worth of that same valuation measure. So that's not the market, it's the valuation measure. Long-term average is around 15 times as fair value. That's the tech boom. That's 1929, just before the market crashed. That's where we are today. And I guess the interesting thing is, well, if we know this is a fact, and it does seem to be reasonably, you know, we've got a century's worth of data, we're measuring it the same way, it all looks pretty straightforward. What should we expect out of US shares running forward? And the real question then is, what happens if you buy shares when the market is expensive, when the market is fairly valued, and when the market is really cheap? And the nice thing about having a century's worth of data, we can actually explore that and understand that, and just look at the historical evidence. And there have been many studies along these lines, and they all show pretty much exactly the same thing. And interestingly, they show pretty much the same thing for all share markets, and it's probably not going to come as a huge surprise to you, I hope, that generally speaking, if you buy a market when it's cheap, over the next few years you do pretty well, and if you buy a market when it's expensive, over the next few years you do pretty poorly, and if you buy a market roughly at fair value, over the next 10 years, you tend to get an average return, which is probably 7 to 8%, which is kind of what you should probably expect out of shares over the medium term. So this is just that data broken up into deciles, in other words, from the most expensive periods to the cheapest 10% of periods. And then it just goes through, well, what's the next 10 years been? And again, if you buy markets, the US, if you bought the US market when it's very cheap, you've got a very good compound annual return. you tend to start at a low PE and end on a high PE. And if you buy a market when it's at its most expensive, you tend to have a very low average range of returns. You tend to buy at an expensive PE and end on a low PE. If you buy in the middle, you kind of get probably an average, which is probably 7 to 8%, which is what probably most of us should expect out of investing in the share market over time. So what does that really mean? It just says, look, if you tend to buy when valuations are up here, you don't get great returns for the next 10 years, you end up at much cheaper values. The same is true for there, the same is true there, and the reverse also holds true. So in some ways, this is very simple stuff, right? It's just taking data and analysing it and saying, well, how'd you go? And if you look at almost all markets, you get exactly the same numbers. But, you know, if that's true, why are we all buying the US share market so aggressively when it's up here? Well, how do you get from here to here? You're the best performing market, right? How do you get from here to here? That's the tech boom, you're the best performing market. How do you get from here to here? That's the roaring 20s, you know. So I think the lesson there is value is a powerful discipline. It's a very hard discipline to fight for, because the only way you can get into a very overvalued state is by becoming the best performer. So in a sense, not only is being contrarian hard, you actually have to stand back from the best performer. But, you know, the market was not great buys there or there. It tended to perform pretty poorly. But again, the nice thing is we've got plenty of share markets in the world today which are in that sort of middle band. You know, so we go back to here, plenty of share markets at 15 PE, long-term average PEs. And again, if we skew portfolios, we can basically get normal equity style returns. So we hope anyway. But it means standing away from the best performer, and we're never going to get the timing right, and standing away from the best performer psychologically is not the easiest thing in the world to do. What are we doing about it in our portfolios? And this differs from the portfolios that you may be in. So if you look at the global share market, at the moment, the weight of the US share market in global shares is 65%, which leaves about 35% in other markets. If you look at how our portfolios are positioned, they're almost the reverse. They're about 20% in the US share market and about 80% outside the US share market. So you can actually avoid the very expensive markets, finding more reasonable markets if you wish to do so, but you have to be a little different from the crowd, right? And if everyone says, oh look, you know, Wall Street had a great week or month or year, maybe you'll look a little bit different from that. And so, you know, the choice is yours. You can choose to pursue the averages and go up and down to the markets, or you can choose potentially to be a bit contrarian and stand aside and look to perform a bit differently. So, how do we see the world slightly more broadly? We've gone through shares. If we just break the world down into economics, share market valuations and currencies, probably it's not going to come as a complete surprise to you that if we look at valuations, we can see the US is very overvalued, Australia is pretty expensive, but a lot of the rest of the world is looking pretty reasonable, so that's good. Economics is not disastrous, but it's certainly flashing warning signs. You know, we are having people having serious conversations around the risk of recession globally. It's a serious debate. It's probably a higher risk today than it's been for a decade. That doesn't mean it's going to happen. Our best guess is it doesn't happen. But, you know, it's a much higher probability today than it's been for the last little while. So unfortunately there are some red dots there. And we think the currency is probably, the $8 probably falls from here. So in a nutshell, how do you position yourself? A little bit cautiously, because you're a little bit worried about the economy. You're trying to skew your portfolios to the cheap markets, avoid that one. You know, it's a fairly logical set of responses. Other key issues that we can look at, we've got the trade wars, which is sort of on again or off again, depending upon which tweet comes out today. And you can sort of see probably some slight defensive elements required in portfolios. The risk of recession is real, so again, you know, you don't want to sort of move 100% into cash or anything as silly as that, but having a few defensive tilts is a good idea. Australian interest rates, we'll talk about the Australian economy, probably going to kind of stay flat to down, so currency unhedged. Iron ore we think is going to drift down back towards $50 a tonne. Again, the $8 should probably fall. US shares are expensive, so again, you're probably more oriented towards European and Asian shares. And within Australia, we've got some pretty expensive sectors. The Australian market as a whole is fairly expensive, but within the market, we've got some very expensive sectors. So again, we would say probably, overweight value stocks over growth stocks in this environment. So let me talk a little bit about the Australian economy, and let's start out with the good news, because there is some good news out there, and that is employment growth has been really strong in Australia over the last couple of years. So again, one of the charts here, basically the economy is the blue line, employment growth is the red line. We're getting far more jobs today than we would usually get from this point of the economic cycle. So why is that? Well, there are a number of special circumstances that have been driving employment growth that we can talk about in a minute. But how, what's that employment growth add up to? It's about $300,000 plus a year for the last few years, which is very high relative to the history of Australia. So one of the really good things the Australian economy has done is employ a lot of people. Now, quite a few of them are working part-time, but jobs growth has been really good, which has kept, I think, Australia going reasonably well under the circumstances. What have been the key drivers to that? Well, Australia's not called the lucky country for no reason. We always luck out, or we often luck out. And, in the slowing economy, we had sort of 2 or 3 drivers which, I don't think were necessarily planned, but which really employed a lot of people. So one of the big drivers was the healthcare and social services sector, which is about 13% of the market. And with the rollout of the NDIS, we had a lot of employment in that sector. The second sector, which is about 8.3% of the economy, is education, and that's really foreign students. And that's been growing very, very strongly over the last little while. Retail has been weak, so retail has been flat to down. And construction was very strong, but now seems to be peaking. So these were all, we have one negative and 3 pretty strong positives. Today, these are sort of more flattening out. The NDIS is probably largely in place. Now, those people who are now employed in that area are not going to lose their jobs because they're mostly government employees. And you don't lose your job if you work for the government, often. Education seems to be, but it's not growing anymore. Interestingly, if you look at visas for Chinese students, they sort of peaked last year. So it looks like the education system's flattening out a little bit. Again, not going backwards, but flattening out. That's going to stay weak. Retail does not look healthy. Construction is clearly peaking and is going to turn down, and that's probably the big swing variable for Australian employment over the coming 12 months. These are likely to flatten out. This is likely to turn negative. So if we look at construction, because construction is a big employer in Australia, you can sort of see here basically construction of apartments and houses. We've had this boom of apartment construction, but the point is, while it's peaked and it's flatlining, it's still at very, very high levels. So it's still employing a lot of people. It's still doing pretty well. Now, as these apartments are finished and completed, that line will start to come down in all likelihood. So, the real question, I guess, is when do we start to see all these apartments completed? And I think the answer is probably over the next couple of years or the next 12 to 18 months. The interesting thing is the number of cranes in Sydney and Melbourne hasn't changed very much. In fact, in Melbourne it went up a little bit. So maybe, in that last phase of construction, there are still a lot of good jobs to be had. But, that's probably going to come down. And we can kind of see why that's going to be the case, because if you look at job ads in the construction industry, this is in construction employment, the black line, job ads in construction, the blue line. Clearly, job ads have fallen away quite sharply. What's happening there? I think employers looking forward can say, okay, look, I can see I've got 6 months work on the books, but I'm not going to have 12 months work on the books, and so I'm not going to start looking for additional employees. As this work rolls off, I'll just let people go, and hopefully we'll find other jobs, probably at lower wages. So you can sort of see construction looks like it's peaking and probably coming off in the next little while. I think, basically that's mostly a Sydney and Melbourne story, but a little bit of a Brisbane story as well. All right, let's talk more broadly around the Australian consumer and try and paint a picture of how they're doing and how that impacts the share market. So in terms of incomes growth, we haven't really had much of a pay rise, generally speaking, for the last 4 or 5 years. That's that's enterprise agreements. You see it used to be averaging around 4% per annum, really coming down recently, so not getting good pay rises. If you look at annual increase of income per adult, again, it used to be about 4% per annum, much weaker for the last couple of years.
Are they real numbers or nominals?
That would be, that's nominal.
So in fact it's not necessarily changed much.
Sorry?
Well, our current inflation rate compared with that of some years ago, the real rates of increase against the nominal rates.
Inflation was probably close to roughly 2-ish% for most of that period. So, and if I'll show you a real income measure in a minute. But inflation today is probably just a little bit below 2. So in real terms, Australians are doing fairly flat. So here is kind of a measure of real household disposable income per capita, which is a slightly artificial construct, right? We per capita just divides us amongst us all. But you can sort of see this has been really trading sideways for the last 4 years. So in real terms, we haven't been getting much pay rises. And if you look at sort of international experience, that was true internationally as well. So the Americans have been getting, we've only been flatlining for 4 years. The Americans, up until very recently, flatlining for 10 years. So, you know, if that's happening in the economy, we're not getting much in the way of pay rises, you know, consumption is also clearly being impacted. That's real consumption. So real consumption is also fairly flat. And you know, from a share market perspective, while the share market is high in part because interest rates are low, you know, from an earnings perspective, this is a bit of worry because basically, I mean, this is the lifeblood of any economy and ultimately of most shares, and that is, you know, you need incomes growth to generate earnings growth. So about spending. So with fairly flat real incomes growth, but rising costs of living, we're seeing people, they're actually increasingly spending more on essentials rather than discretionary, and discretionary essentials are sort of defined here. You know, essentials are sort of utilities, discretionary is everything, a lot of other stuff there. And as incomes growth has sort of slowed down, people have increasingly been spending money on the essentials, and you can sort of see the share of essentials versus discretionary there. So this is real, it's having an impact. You can kind of see it sectorally. And this is a survey, so this is people getting asked questions. It's not necessarily validated by any other means, but it's an interesting survey. And again, you can sort of see people are sort of very much complaining that their cost of living is going up. That's probably energy prices, fuel prices, childcare, that sort of thing. You know, it's fairly clear that the Australian consumer's been squeezed. You know, not much income growth, in real terms probably no income growth, gradual cost of living increases, moving up, people feeling a bit poorer, people spending more on essentials, not so much on discretionary. What about liabilities? So we've got fairly flat income growth in Australia. What about our liabilities? Well, we've got quite a lot of household debt in Australia. These are Bank of International Settlement numbers, the gold, silver and bronze, as implies. This is just household debt. So the government debt in Australia is actually not that excessive at all, but the consumer is very indebted, largely to mortgages. Basically, it's that. So yeah, household debt's the second most indebted in the world, and there's a range of different measures you can look at. They all come up with the same thing. And yes, interest rates are low, but if you look at the debt servicing ratio, it's still very high. In other words, you know, there's sometimes an argument, well, yes, we've got a lot of debt, but interest rates are low. True, but if you're actually going to have to repay the debt, which is a novel concept for some people, it is taking a big chunk of people's incomes. So, you know, again, the picture that emerges in Australia, I think, is, you know, not for every household, some households are debt-free, but for a lot of households, particularly in that sort of, you know, 30 to 50 sort of bracket, a lot of debt, not much incomes growth, you know, feeling pinched a little bit at the moment.
How did Switzerland not even get on that map? It's number one on the one where the ratio.
I think the income growth is different.
Yeah,
so
that's the difference as well.
Yeah, so it's the income growth, and I think also, yeah, so Switzerland has a lot of debt, but they also have decent income growth, they have a lot of savings. We've got a lot of debt, we have very flat incomes growth, not much savings. and they've got negative interest rates. So it helps, right? Our interest rates are negative at the moment. Okay. The interesting thing at the moment as well, and this is sort of a fairly temporary thing, but it's an interesting and quite an important thing, is, you know, we've seen the Royal Commission. The government's clearly backed away from some of the suggestions that Commissioner Haynes had. Wisely or not wisely, you can form your own judgment. But one thing that has happened to the banking system is the banks were making a lot of loans at interest-only lending, and that was probably, I think, in retrospect, seen as somewhat reckless. A lot of those loans are now basically coming due. Typically, an interest-only loan lasts 5 years and it gets rolled. Now, some are being rolled, but a lot aren't. And you have this big pipeline of interest-only lending that's coming due, and the banks are pretty aggressively pushing people out of interest-only into principal and interest repayments. And there's some survey data, and you say, well, why are people switching? And the blue line is it's a personal decision, and that's probably driven largely by the fact that interest-only borrowing rates are now higher than P&I borrowing rates. So if you can afford to pay it back, maybe you ought to pay that high interest rate. In a lot of cases, it's been forced on them by the bank. So the banks have been pretty hard line on this, and I think the banks have been fairly hard line because the regulator said to the banks, you really can't write 40% of your book as interest-only. That's crazy. Wind it back, and they've been winding it back pretty successfully. But the interesting thing for Australia is if you do that and you start converting all these, you know, $140, $150 billion of interest-only borrowings every year, largely, if not entirely, back to P&I, that means effectively your payments go up considerably, right? Because you start paying back the principal, and effectively, in terms of how much does it increase by, it's you know, 25 to 35%. It varies a bit by state. These are big increases in terms of what people are having to pay back. And this is also kind of hitting part of the Australian consumer market quite hard at the moment because, you know, whereas previously they were paying X dollars, it's now 120 or 130% of X dollars. It's a large increase. So again, sort of squeezing the consumer just that little bit more. What about savings? Because if we've got a lot of savings, this isn't so much of a problem. Now, you know, Australia does have compulsory superannuation, so we do have savings, but you know, that's not accessible for most people until they hit retirement. So if we look at the consumer in Australia, and this is probably, I think, probably the most important chart that really tries to explain Australia's challenge. And I'll just break it down. So this is all real household consumer income. Sorry, household consumption growth. So in real terms, that's about 2% per annum. Yeah. It's been fairly flat, and so what that implies is in real terms, consumers have kind of sustained their spending. So why have they sustained their spending? Well, in part, economic theory tells you that people, when they spend, don't tend to look too much at this year's income or last year's income, whether it's up or down a bit. They tend to smooth out over time because they tend to sort of look at consumption over a longer period than the short term. It's also probably partially been sustained by the fact that we've had very, very strong property markets, and so if your asset is going up in value up to recently, you know, you're willing to keep spending. The interesting thing here is personal income growth, disposable income growth. Again, it's a real number, has been lower than consumption in real terms for about 4 or 5 years now. And therein lies the challenge, because I was at a lunch with the head of research with the RBA and a number of other people, obviously, and she essentially put up a very similar chart to this, and she said it's not sustainable, and it kind of isn't. So, you know, how do you get out of this? Well, the best way to get out of this is for the incomes growth to go up. That's what everyone wants to happen. And that's why the RBA keeps saying, and if you read their speeches, they go, literally, you know, an increase in income would be very welcome. But I don't think they think it's going to happen anymore, because they kept on hoping and hoping that would happen. It just hasn't happened in recent times. So the best way is for the light blue line to go up. Possibly not going to happen. Maybe we could get big tax cuts, which would kind of push it up a little bit. So there's more than one way to skin the cat there. But, you know, probably not going to happen. If that doesn't happen, and we're spending more than we're earning, we've been drawing down the last line here, which is the savings rate. Now, we could keep drawing down savings for another 12 to 18 months, maybe a bit longer. But at some point, this has to break. Something has to give here. Either we get more wages, we run down savings for another year and kick the can down the road, more than possible, or the dark blue line starts to converge with the light blue line, and we start spending within our means. And the worst case scenario is the light blue, our consumption goes down to our income level, and we start increasing our savings simultaneously. And that's more the recessionary style scenario. But therein lies our quandary for Australia. How do we get out of this particular issue? That's the challenge. Now, the best way forward is incomes growth. That's why you might see tax cuts and fiscal policy, because that's another way of just trying to stimulate or push this light blue line up. But you know, the way things are going, Australia is going to come to a bit of a crunch point in the next few years, and it suggests to me at least that the very slow growth we've seen over the last few years is likely to be in place for the next few years until we get decent incomes growth. And as we showed from the earlier charts, we're not seeing a huge amount of wage increases at the moment. So this is why the RBA has been cutting interest rates. You know, the economy is growing fairly slowly. This is the CBA measure of output, and there you can sort of see the Australian GDP. I think the RBA remains perpetually optimistic. They've been, you know, they're the most optimistic regulator and you can find. But I think, you know, clearly having cut interest rates 3 times, they're saying to you something isn't working as we would expect. And they've clearly also indicated in their statements that they expect interest rates to stay low for a long period of time. I think that's fairly realistic. So I suspect for Australia we're looking at very slow growth for a number of years until we get incomes growth coming back into the system. So what does this all mean? So, you know, if you look at policy, the RBA has cut interest rates 3 times. The market expects them to cut once more in February. I think that's fairly likely. The market and the RBA has made it fairly clear they do not want to do the European thing and go to negative interest rates. I think they see that as counterproductive. And so while they may move one more time, after that they probably move into unconventional monetary policy. And they start buying bonds. They'd really like to see the currency down, and they keep asking or begging the government in each of their speeches effectively to step up and do some strong fiscal policy. And the Morrison government's been somewhat tone deaf in this area and keeps saying, no, we're going to get the budget surplus in place and we'll keep our AAA rating. I think that's a mistake, but that's how they're thinking at the moment. Look, just talk really quickly about the global economy. So our economy is looking, fairly flat and somewhat challenged. The global economy is actually looking worse. So, we're not doing too badly. The global manufacturing sector is clearly in recession, but manufacturing isn't the biggest part of any economy typically. But those economies which are dependent on manufacturing, these are purchasing managers indexes. You see Germany is looking dreadful. Japan's looking very ordinary. Just another measure of China looking pretty poor. Even the US manufacturing sector has fallen away a little bit. So if you look at the global economy, the real key question there is this manufacturing slowdown becoming more broadly based and going to extend into the services sector? I think the answer is we don't know yet. I think probably the best case scenario is for the US economy to sustain reasonable growth, even though the manufacturing sector is falling away like other manufacturing sectors. And why would that be the case? Because the US consumer is not doing too badly. You can see here an interesting little chart which shows consumer confidence, which is pretty much at 20+ year highs. American consumers are really optimistic and happy, and the blue line is CEO confidence, which is at not quite recessionary lows, but pretty low. So why do we have consumers in America simultaneously very comfortable and CEOs very depressed? Well, if you ask small businesses in America what's the single biggest problem you have, it's labour costs. And so what does that mean? That means people are actually starting to get wage rises in America after many years of not getting any wage rises. So that's good for middle America, and it's good for the American economy. It's not so good for Wall Street, which basically, because it's taking money away from profitability. So profit margins and wages are actually fairly closely interlinked. and we can start to see labour is starting to get its power back, and you're starting to see in America, at least after 20 years of very flat increases in wages, some increase in wages, which is why the CEOs are not so happy. They also don't like not being able to outsource everything to China, which has clearly sort of gradually been taken away from them. So their whole business model, their whole paradigm, which was really based on globalization and outsourcing, has really been quite challenged at the moment, and that's probably going to impact profit margins in the next little while. So what does this all mean for us if we look at the next 12 months? So we would suggest that in terms of the investment implications, you should probably have more exposure internationally than to Australian shares. And again, although the international market the economy has its challenges, international share markets other than the US look pretty reasonably valued, and reasonable valuations are a great place to invest. You should probably be underweight US shares in your international portfolios. We do think the $8 continues to fall. We think the RBA is pretty much on hold and we're into a low interest rate environment for the foreseeable future. And we might see quantitative easing here. So again, being offshore and unhedged is a good place to be, because as that Australian dollar falls, it boosts the value of your offshore investments. It's a nice free lunch. It's a bit of a free kick for Australians. And if we were to have, harder than expected economic landing, the $8 tends to fall quite sharply in those circumstances as well. Within the Australian share market, I think we can quite clearly see there are parts of the market that look reasonably fairly valued and parts of the market that look really, really expensive. Going for the reasonably fairly valued parts of the market hasn't been a winning strategy. You've done okay, but you haven't done as well as you could have done, but it may not be a bad place to be running forward. So I think we would say, bias your portfolios towards value-style investing managers if you can. And the key risks really are, for Australia, this deficiency in income with a very indebted consumer, and globally a very different risk, and that is this manufacturing slowdown and the question of does it extend into the broader economy? Still yet to be determined. We don't know that yet, but that's sort of a risk at the back of people's minds, and should certainly be informing at least some of your decision making. And I think what it means for those people who are relying on fixed income, cash rates and interest rates are likely to stay low for the foreseeable future, unfortunately. So, retirees tend to get penalised in this environment, and borrowers tend to get subsidised. That's what the RBA does, basically, and it's not exactly fair, but that's pretty much what they do. So, with that, I'd say, look, thank you very much for your kind attention. Happy to answer any questions or get any more additional comments if anyone's got any. So thank you.
Yes. I noticed that there's no